So guys, welcome. So we are going to do preparation of the final account. Preparation of the final account of a company. Preparation of the final account. Preparation of final account of company. So preparation of the final account of the company. Preparation of the final accounts of the company. Now in this case we shall focus on three accounts. So our focus will be on three accounts. So we shall focus on three accounts. So we shall focus on three statements, which includes on three statements, which include. So we shall talk about the income statement, and the another comprehensive income, and other comprehensive income, comprehensive income. Number B, we shall talk about the statement of change in equity. Statement of changes in equity. So statement of changes in equity, but we shall be interchanging this statement with the retained earnings account. Retained earnings accounts. I'm saying we shall be interchanging. So remember, retained earnings account or the retained earnings is part of the statement of change in equity. But in some questions, we shall find that you don't need to prepare the statement of change in equity because all other components will remain the same, and only the retained earnings account will be affected. So in that case, we shall only prepare the retained earning account separately. So I will show you the format of this one and the format of the other one separately. But remember, retained earnings is part of statement of change in equity. So it is part of it. Retained earnings account. Other people call them the income surplus account. You can call them the income surplus account or whichever name you want to call it. And then number mission is the statement of financial position. Statement of financial position. So we shall focus on those three when we will be talking about the company account. So we have another one, statement of cash flows. Statement of cash flows, we shall cover it differently in each topic so that we can cover what is required there. So, but we shall focus on the three items. So remember the first one, income statement, not so much different with the one for the sole trader. Remember we did the sole trader account. So not so much difference, but just some minor error. Statement of change in equity, that one is a new one, which we shall talk about it. And then the statement of financial position also not so much different. We shall have some extra figures or extra items that we shall also incorporate in this statement when we talk about the company. So same format like the one in the sole trader, but we shall be changing some items. We shall see the main changes as we progress. As for now, just know we shall focus on those three accounts. That one is fine. That one is okay. I think that one is okay. Now we can move on. We can move to so let's see the format of the income statement. So income statement. So we say XYZ income statement. Income statement for the year ended. For the year ended. So for the year ended, our year ended is XXX. So we start with the sales kama kawaida. Sales. Then we less sales return or return inwards. Sales returns. So that we can get our net sales. We get our net sales. Then now we can less cost of sale. Cost of sales. So we start with the opening stock. Opening stock. Then we can add purchases. We can add the purchases. Then we can add carriage inwards. Carriage inwards. Then we can less purchase return or return outwards. Purchases return. Return or the return outwards. You can also less drawings if the drawings is there. So I'm not going to put the drawings, but if you have drawings, you less the drawings here. Drawings of stock. So keyword drawings of stock. So if you have the drawings of stock, it will affect the purchases. So it reduce the purchases. If you have the wages, you add. So if you add direct wages, so to be specific, direct wages. If you have the direct wages, direct wages is a cost of it's a part of cost of sales. Direct wages. So you add the direct wages if there is a direct wage. Now in this case itaweka tu hivyo, so sitaki kuwa na mambo mingi, but that's in case. So we shall get the cost of goods available for sale. Cost of good available for sale. Then you can less our closing stock. So that you can get the cost of sales, the here apple. Then when you less, you get the gross profit. Gross profits. Gross profits. That one is okay. Now we can add other income. So add other income. So we can add other income. Other income. So for example, we can have a gain on sale of an asset. Gain on sale of asset. Or disposal. Let's do the word disposal. That's the word they mostly use. Disposal of assets. So when you have a gain, that gain is treated as an income. We can have other gains. So I don't want to give all the incomes. So other incomes which you can have here, we can have discount to receive as an income. We can have decrease in provincial for bad debts. You can put it here. We have a decrease. Then you can have also investment income and so on. So for now, naeka pio moja, but the rest you are conversant with. You did it in sole trader. So total income. Total income. Now we can less our expenses. Expenses. So for example, you can have auditor fees. Auditor's fees. You can have auditor's fee. You can have director salaries. Salaries. We can have other expenses, for example, other expenses which they can appear here. Sales and marketing, distribution expenses, advertising expenses, general expenses, all those. So for now naeka tu hizo so that we can get, so we can have more, but for now mimi naeka hivyo so that we can get profit before interest and tax. So note this one, and tax. So the only expense which you don't remove kwanza ni interest and tax. So interest utatoa kivyake. So interest is the finance cost. So the finance cost, so there are, for example, interest expense and the bank charges, all those are the finance cost. So hizo utatoa later. So ukishatoa all the other expense, auditors fees, director salaries, advertising expense, general expenses, blah blah blah. Then now once you less, you get the profit before interest, you get the profit before interest and tax, then you less the interest. So less interest expense, expenses, you get a profit before tax. Profit before tax. Now ukishafika hapo now kimebakisha ni kutoa tax, so you remove the tax. So then less tax. Then now you can less tax. In Kenya, tax is 30% if you're in Kenya. If you are in another country, check the applicable rate. So, but in Kenya, profit after tax. Profit after tax. Or you can also call them the net income. Net income. Here, net income, that is the profit after tax. Or you can call it the net income. Net income. Now, once you have the net income, you can prepare the statement of changes in equity. 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 Now, what are some of the components of the statement of changes in equity? So let us see first the components. Components of statement of changes in equity. Of changes in equity. So what are some of those components? Now the first component is called the stated capital. Stated capital. Stated capital. You can also decide to go with the ordinary share capital. Ordinary share capital. Number 2, you can have the income surplus. Income surplus. You can also call them the retained earnings. Retained earnings. Income surplus, or call them the retained earnings. Then number 3, you can have the revaluation surplus. Revaluation surplus. And number D, we can have what we call the general reserve. The general reserve. The general reserve. So those are the components of the statement of changes in equity. So you shall find those items as the items which appears in the statement of changes in equity. In the statement of changes in equity. Now, sometimes these accounts might be affected. So if these accounts are affected, then you need to adjust. So let us prepare the format. So we say statement of changes in equity for the year ended. For the year ended. So you don't know the period, so tunasema xxx blah blah blah. So tunaanza na details. So to our details tunaenda tunaanza na the first one, stated capital. Stated capital. Income surplus or the retained earnings. Income surplus. Revaluation reserve. Revaluation reserve. Revaluation reserve. Kwa revaluation reserve tunaenda kwa general reserve and then total. General reserve. General reserve. And then the total. So kama kawaida we start with the balance brought down. Balance brought down. So from the total balance, unaangalia total balance. Total balance. Then when you add them together, so you add this one plus this one plus this one plus this one, you get the total. Now you start checking which accounts, which informations affects this account. For example, issue of share. So if issue of share will affect issue of shares, will affect, so it will increase the capital, and then it will not affect this account, it will not affect this account, it will not affect this account. So that one make up a total. So issue of shares would affect the capital account. Then we can talk about the net profit, profit after tax. So profit after tax or the net income. I'll just call it the net income. Net income. Net income. Net income. Net income ndio hii hapa. So net income will affect the surplus account. The income surplus account. So it will increase. So profit will increase. Remember, for if you have a loss, for example, assume you have a net loss. A net loss, it will reduce this account, income surplus. But kama ni profit, it will increase this account. And then huko hakutakuwa, so it will not affect this account, this one, and then the total, naweka hapo. What are other items? Dividends payment. So when we pay dividends, so dividends. Now dividends is paid out of the income surplus. So dividends is paid out of the income surplus. So dividends, it is paid, so here I reduce the account because it is being paid. Then total unaweka huko, the total dividends hapo, tunasonga mpaka pale tutafika mwisho. So tukitoka kwa dividends, transfers. Now transfers means you transfer something from one item to another. Now for example, let's assume you made a transfer of 10,000. Let's assume you made a transfer of 10,000 from your income surplus to general reserve. So if you made a transfer, for example, you make a transfer here of 10,000, I assume that one is 10,000. So when you made a transfer, it means unatoa hiyo pesa hapa unapeleka to another account. So any transfer reduces the amount in that account which unatoa. But the amount, the account which is receiving itakuwa positive. Let us assume we are transferring this amount to reserve. So it is what, for example, this one amount is 100. Inatoka hapa 100, so tuna minus 100, then tunaweka hapa 100 positive figure, so ina increase. Then the total itakuwa ni 0 kwa sababu ita cancel out. So when you do a transfer, the total is always 0. So when you do a transfer, the total is always 0. Goodwill written off. Sometimes you can have goodwill written off. Goodwill written off. Now for goodwill written off will also affect the income surplus account. Will also affect the income surplus account. Unaweka total hapo. Goodwill written off will also affect the income surplus account. Upward revaluation. So we can have upward revaluation. Upward revaluation. Upward revaluation will affect the revaluation account. So upward revaluation kumaanisha imeongezeka, so you add, then total unaweka huko, the total value, so ukiadd hapo ni total. Then you can have downward revaluation, downward revaluation. Downward revaluation. Downward revaluation will reduce the revaluation value. That order. Now we can get the balances. Balances carry down. So balances carry down. Hapo. Ingine hapo. So kila wake atakuwa na balance, then the total. So that's just a simple account of the statement of changes in equity. Now, in most situation, you need to know this one. In most situation or in most scenario, it is not a requirement to prepare this statement of changes in equity. It is not a requirement. In most situation, what you need to prepare is only the income surplus account, the retained account. So this one peke yake, you start with the balance brought down, you add the net income, you less the dividends, both interim and final, you less any transfers, you less any goodwills available, any goodwill written off available, then you get this balance. Now this balance is what we shall use in most scenario if the other items are equal. For example, assume we don't have issue of shares, you don't have any revaluation in the question, you don't have any reserve in the question. Now in that situation, it will be advisable. It will be advisable to prepare the retained earnings account. It will be very, very advisable to prepare the retained earnings account. So you don't need to prepare the settlement of changes in equity, and you know the balance up, balance brought down, hakuna any item in effect. So the balance brought down will be the same as the balance carried down, kwa sababu hakutakuwa na any amount which affects this account. Na pia revaluation unapata hakuna revaluation kwa swali. So kama kuna revaluation kumaanisha the same figure here ndio itakuwa hapa chini. So no need to prepare the statement of change in equity. Just prepare the one which is affected. For example, the income surplus, most scenario or in most cases is one which is affected. So you should prepare that part. Now, let us move on. Let us prepare the retained earnings account. Just a small retained earnings account. Retained earning account. So retained earnings account. Retained earnings account. This is the format for the retained earnings account. We call them the appropriation account. We also call them the appropriation account. Appropriation account. So we start with the balance. Down. Then net income. Then you get the total. Now we can have a loss here, depending with the question. So if it's a profit, you add. If it is a loss, you less. Then payment of dividends. So we say dividend payments. Dividend payments. Dividend payments. So we have interim dividends. Dividends. Then we have final dividends. Final dividends. You can have goodwill written off. Goodwill written off. Goodwill written off. Then transfers. So if we have transfers, unaweka hapo, then we shall get the balance carried down. Balance carried down. So this one is the retained earnings account or the income surplus account. So this is the retained earnings account. So the retained in we can also call them the income surplus account from the statement of change in equity, income surplus account. Or you can call them the retained earnings account. So you can also call them the retained earnings account. That one is okay. Now we can look for format of balance sheet. Just a small format of balance sheet. So just a small one, just to explain what we are supposed to do. So tunasema XYZ statement of financial position, statement of financial position. That as at XXX. So kama kawaida we start the non-current asset. Non-current assets. Non-current assets. So you can start with the goodwill. Unaweka hapo. Talk about land there. Yeah. Talk about property, plant and equipment, PPE. Weka hapo. And remember, you need to PPE. You need to remove the accumulated depreciation. So remember, you need to remove the accumulated depreciation. Then you add them. You shall get the non-current assets. Non-current assets. Just a format. Then current assets. Current assets. So you can start with the order of liquidity. The order of liquidity. Let me see. For example, we can start with inventory. Inventory. Naweka hapo. We can put receivables. Receivables. Naweka hapo. Prepayments. Prepayments. Unaweka hapo. Short-term investment. Short-term investment. Short-term investment. Unaweka hapo. Then cash. Stock bank. Whichever is available, or both of them. So you get the current assets. Current assets. No, we can get the total assets. Total assets. Naweka hapo. Now, need to now say financed by. Financed by. We start with equity. Equity. So we say ordinary share capital. Ordinary share capital. The statement of statement of changes in equity. We had ordinary share capital. We had income surplus. Income surplus, or what we call the retained earnings. We have we can have general reserve. General reserve. Apart from the general reserve, what else can we have there? We can have share premium, preferred dividends, blah blah blah. So we can have share premium. Share premium. Then preferred dividends. preferred dividends. I'm a preference dividends. Then that we can go to non-current assets, non-current liabilities, sorry, non-current liabilities. You can talk about long-term loans. You can also have debentures hapo, bonds. So unaweza weka loan, you can put debentures, you can put debentures, you can put the bonds and so on. So because of space naweka tu moja, then tunaenda current liabilities. Current liabilities. So for current liabilities we can have many. So the common one we know is payables. That's the common one. Now we can have others. We can have accruals. We can have accruals if there was any accruals. So the outstandings. So accruals, we can put them. Accruals can be in many forms. So for example, the tax for the previous year about Mjaripa, the dividends were proposed, not yet paid. Also those will become liability. So dividends which were yet to be paid, but they were never paid, but they were for the period. Also that one taziweka hapo. But for now ikae hivyo. What else can we add? So unaweza interest payable, dividends payable. You can put the income tax or the deferred tax if they were not paid and so on, so that you can get, so ni mingi, then you can get total equity and liabilities. So total equity and liability, total equity and liability. Now I think we can go to our past paper now. We can move to our past paper, and we shall start with this sitting of the sitting of August 2024. August 2024. I think that was the question that was tested. So that one was simpler. August 2024. So let us move on. So the question is August 2024. Question number 3B. The question is about Hibiscus. So the following to balance was extracted from the books of not Hibiscus Ltd. as at 30th June 2024. So we have the information there. So that information to your balance. Then you have the additional information. Information number one is about depreciation on straight line basis. That one is fine. Number two, as at 30th June 2024, account receivables include 130 due from Johnson Wetu, who was now being declared bankrupt. It has been decided to write it off, so that is bad debts written off. So it's a bad debts and expense. So allowance was also decided to be 10% of the account receivables. Rent, we have a prepaid rent of 52,000. Then administration expense, we have an accrual or an outstanding amount of 95,000. Then the company paid interest on debentures for the year ended, that is June 2024, on 31st July 2024. Now that 1st July 2024, that's outside the current year. So kumaanisha we shall treat it as an outstanding for this year. That one is okay. Inventory was valued at 72,80,000. The company's director proposed a preference shares dividend to be paid and also a dividend of 10% of the ordinary shares. Tax is 30% of the net profit. Require number one, statement of profit and loss. And number two, the statement of financial position. This one is easiest. It is the most easiest question. So anaitwa Hibiscus Ltd. So we say Hibiscus Ltd. Income statement for the year ended Now the year ended yake ni ngapi? The year ended yake ni 30th June. 30th June 2024. So tutakuwa tukisoma additional information, then tunaangalia kama kuna any working that affects. So tunaanza, we start with the sales first, but tutakuwa tukiangalia additional information. So from the question, what is the value of the sales? So the sales from the question iko huko juu ni 724,000. So should we put it in thousand? Wameka in thousand? Yes, wameka in thousand. So we shall put the hours in thousand. So take two columns, Kenya shillings there na Kenya shillings there. Sijui kama kwa tumefinya sana. Kenya shillings. So tunaanza na sales. Sales 724,000. Turudishe kidogo tu hapa. That one will be okay. 724,000. Now, do we have sales return? Now, from the question, we don't have the sales return. So, sales return, there was no sales return. So, we can consider less cost of sales. So, less cost of sales. So, kama kawaida tunaanza na opening inventory. Opening inventory. Opening inventory. Now, opening inventory koko juu, it is 54,600. 54,600. 54,600. We can add purchases. We can add purchases. Now purchases naiona ni ngapi hapo? 548,600. 548,600. So you add 548,600. Then we check if there are other information. Yes, we have return outwards. So we have the return outwards. Iko pale nilikuwa nimeona hapo kwa inventory hapo chini yake 10,400. So 10. So we are supposed to less the return outwards. So less return outwards. Na ni ngapi? 10,400. 10,400. So that you can get the cost of goods available for sale. Cost of goods available for sale. Available for sale. Itakuja ngapi? So hii itakuja ni 54,600 plus 548,600 minus 10,400. Hiyo ni 592,800. Now we can less closing stock so that we can get our cost of sales. So what's our closing stock? So closing stock iko kwa information number 1, not number 1, number 2, number 3, number 4, number 7. Inventory was valued at 72,80. Tunaweka in thousand, so tunaweka in thousand, kumbuka in 72,80. So minus 72,80. So mimi napata ni 585, 520. 585, 520. I think now we can get our gross profit. Gross profit. So 724,000 minus answer napata 138 for 80. So 138 for 80. Now we add other income. Add other income. If anyone we have discount received somewhere, you can start with that one first. I think niliona somewhere discount received. So discount received, I saw it somewhere. Discount, okay, nimeiona pale. Discount received is 1690. So we start with the discount received. Discount received 1690. Now let us do another working allowance for bad debts. So we do the working for allowance for bad debts so that we see if we have an income or an expense. So we do it here, allowance for bad debt. So ni ngapi from our trial balance? So hiyo unaenda direct kwa trial balance. Allowance for bad debts. Allowance for bad debts. Ni 2340. So now I'm 2340. So this one is for the previous year. So this one is the previous year. So it was there as the year ended. Now that's for this year. Now for this year, wametuambia the allowance for bad debts, information number what? Information number 2. As at 30th June 2023, account receivables include 130 that was written off, and then the percentage, the percentage. Information number 3. Allowance for doubtful debt as that is June was adjusted to 10%. So we need that 10%. So current year allowance. So we just want for comparison purpose. So 10% of the receivables. Now the receivables huko juu ni ngapi? Receivables huko juu ni ngapi? Account receivables ni 42,900. It is 42,900. But remember, they said that there was a person who was declared bankrupt. It was unable to pay, so that one will reduce our receivables of 130. Let us compare that one. So itakuwa ni 42,900 minus 130 times 0.1. So 42,77. 42,7. So we have an increase. So this one is an expense. So an increase of how much? Minus 23, 40, 19, 37. So automatically this one is an increase. So we don't have any other income. So in that case, we don't have any other income. So tunasema total income. So in that case, tunajua no other income. Total income. So we add the two. So tunasema ni 138,480 plus 1690. Tupatie 140, 170. This one is 140, 170. Now we can less our expenses. So less expenses. In the first expense that tutaweka hapo ni the increase in allowance for bad debt. So kama ungepata decrease ingekuwa income. So 1937. So we are going to remove it, 1937. Now we can go now one by one to our additional information. Now in our additional information number 1 is about depreciation. Now before we go to the depreciation, we had also another bad debt. So we have bad debt. Bad debt. Yangapi? 130. So remember we have 130. But we have another one in the income statement. So we have another one in the income statement. Yangapi? Huko juu we have another bad debt. Nilikuwa nimeona bad debt written off. I think 520. 520 hapo nimeiona. So 520 plus 130. This one is 650. Nataka niume space baka itoshe. So next we can go to information number 1, depreciation of freehold. Depreciation of freehold.